Hello, chart watchers, and welcome to this Thursday, May 17th Market Watchers live show with your hosts, Tom Bowley and Aaron Swinland. For those of you joining us for the first time today, welcome. And for our regulars, welcome back. Today, we are trying to keep mostly the uptrend intact, especially on the small caps. You can see the Dow Jones Industrial Average currently down off of its highs, down 2 points. The S&P still staying in positive territory, up nearly 4 points. The NASDAQ up 9. And the Russell 2000 up more than 0.5% today, continuing its relative outperformance, breaking out to new fresh highs. These are all-time highs, by the way. 10-year Treasury yield continuing to move up almost 2 basis points to 3.11% as it continues breaking out to 7-year highs. Volatility index under pressure, down at 13, down almost, roughly 2.6% today. XLE, the energy group, leading the action today. Within the space, you can see a couple of the industry groups. The exploration and production group, you can see having a very, very strong day, up more than 2% today. And also oil equipment services having a strong day as well. Industrials, haven't really talked much about leadership from this group in quite some time, but it is the second best performing industry group today, trying to break out to about a 1-month high, maybe, well, let's call it maybe 3-week high. A couple of stocks, though, not faring so well today. These are the two worst performers on the S&P 500. CBS Corp down more than 6% today, and you can see Cisco reported earnings gap down. Even though they beat top and bottom line, they did gap down. However, some of the buyers are resuming this move, or trying to resume the move back to the upside, still down 3.3% for the day so far. And with that, let me bring in my co-host, Erin. Happy Thursday, Erin. How are you?
Yes, happy Thursday to you as well. I'm doing great. It's a beautiful day, blue skies, of course, in Southern California, like there would be anything else.
Yep. Well, I'm not going to say we have that. We are actually in one of these patterns right now. I was looking for a day to play golf, and I might have to look for June because we've got like the next 10 days, they're calling for rain here.
Aw.
Yeah, southeast. So we're kind of just in one of these patterns. It's spring. It's supposed to, I don't know, supposed to be bringing May flowers. I'm not sure if we're gonna get all that. But how are things in the Netherlands, Julius? Welcome to the show.
Pretty good, Tom. Pretty good. Thanks again, and happy to be back again. Yeah, we're doing good here. Summer seems to be starting. Weather's getting better. I love it.
Yeah, I think
Although it's like,
don't you normally have weather there similar to what we have here on the East Coast in the U.S.? I mean,
yeah, pretty much.
Okay,
Pretty much.
Not that I've ever been there, but as soon as I get that invite, I'll be there for sure.
Yeah, for that IBC, the beer convention.
That's right.
There you go. Well, we do have a lot to get through. Julius is actually going to be with us all day today. It's going to be a really exciting show because, well, I'm not giving away. I'm not letting the cat out of the bag here. Erin, I'm going to let you take it away for the update and the announcements and so forth, the agenda, and we're going to get into the show.
All right, let's do this. All right, weekly schedule. Tomorrow we have everything stock charts where we're going to learn something new, I'm sure. And then Monday and Tuesday, Julius is going to be back. He's going to be filling in for me while I am up in the woods in a cabin without Wi-Fi. David Keller will be joining on Wednesday, returning. And then we have, as far as today's agenda, we're going to start off, of course, Julius is here. He's got a really interesting presentation for us. 10 in 10, we're going to start off with Microvision, MVIS. And then we're going to finish off with a very interesting segment on correlation. So definitely stick around for that because Julius will join us in the discussion there.
Yes, the correlation is the one I was kind of referring to. I mean, obviously, Julius will have a great presentation for you here in just a few minutes. But correlation, it's going to be a three-headed monster. Erin and I and Julius all getting together, kind of showing the ways that we look at the market to kind of bring together maybe some trading ideas. So you're definitely going to want to stick around to see correlation. But let me go ahead and get into what is going on so far today in the market. We do have the 10-year Treasury yield, as I mentioned at the open of the show. It is moving higher again. We are in another one of these moves to the upside. How far it goes is anyone's guess at this point, but it does continue to move up, and it's been mostly because of solid economic news. This morning, initial jobless claims, actually a little disappointing, 222,000, market expecting 215,000, so a little bit more than expected. But the May Philadelphia Fed survey came in at 34.4. The market only expecting 21.0. That is a huge beat in that survey. And so I'm not surprised to see folks selling off in bonds and moving that money into equities. April leading indicators came out or at 10 a.m. this morning. They rose 0.4%. That's exactly what the market was looking for. And as a result, you can see a 10-year Treasury yield moving higher. I wanted to go through and take a look at some individual sectors and some industry groups today before we get to Julius's presentation. So first, let's take a look at the XLE. This is, of course, energy, the energy ETF. I wrote about this in my blog. We were right up against some serious overhead resistance. And if you look down, you see that where RSI is now up at 80. And so you wonder, how far can you go? You know, some purists say, well, you get an RSI at 70, it's time to sell. I think overbought can remain overbought for a period of time. And if you look back to December, when we first became overbought, which was just before Christmas, we were just making a major breakout. And if you just said, hey, I'm selling because the RSI is at 70, this is what you miss. You miss a big move to the upside while you're waiting for the overbought conditions to come back down. Really what happened is, as we continued moving higher, you can see that the momentum continued to strengthen. But at the very top, look at the PPO start to roll over. The RSI rolled over. So we had a negative divergence, and then things began to slow. Also, right near the top, you can see a pretty bearish looking engulfing candle that came just before that final top. So you start to get some warning signs. So while RSI is a great tool, keep in mind that 30 to 70 is kind of that oversold to overbought area within a trendless market. As the market begins to trend, it's not unusual to get overbought like we are now and remain overbought for a period of time. I see nothing on this chart. I was a little wondering in the blog this morning whether we could take out this resistance. So I was against taking on new positions, being overbought and at resistance. But check out what the XLE is doing today. I'm not sure where crude oil prices are now. I know this morning earlier we were above $72 a barrel, continuing in an uptrend. And it was, for a while, crude oil prices were moving higher, and yet the XLE was not following suit, even though there's a pretty strong correlation, positive correlation between the two. And I'll pull up that WTIC. Actually, let me just add it to this chart. I think it'll be easier to do it this way. So if you go down to the indicators and you go to price, you can put in the WTIC, which is crude oil. I'm just going to put it up above, move it above the RSI. And then I like to make the height bigger so you can get a really good look at what's going on here. But check out, we broke out above prior highs on crude oil back in mid-March and actually had a double top in play by the end of March. And yet the XLE was doing nothing relative to where it had been back in January. It's not even close. So as crude oil prices continued, look at what the XLE has done. It's begun to play catch up here. Very important. We know there's a strong positive correlation here. So when you see one part going in a certain direction and the other one not doing it, many times you start to play catch up, and that is what's happening with the XLE as it breaks out. Crude oil prices at this point showing no signs of weakness. So I think energy continues to look very strong. Within energy, I did mention at the top of the show, a couple of industry groups performing extremely well today. You got the exploration and production index up 2.69% right now. Another illustration of what can happen when you get overbought. Doesn't mean that a lot of selling is going to take place. It's not some magic formula. It's just telling you maybe that you want to be careful, especially if you're entering. It normally isn't a great sign to be buying, getting into a habit of buying overbought stocks or sectors. But here we continue to push higher. The RSI now is up to 79 on the DJUSOS. But again, no real signs here of faltering. So still looking pretty good. Another area within the energy space. Oops. Typo. Does matter to type it correctly. Oil equipment and services. Couple of 2 or 3 days here, really solid action, but we do have overhead resistance coming up on this group. So just looking at these two charts, I wouldn't even have to put any kind of a relative chart on here. Clearly, to me, the production stocks are outperforming the equipment services, oil equipment services stocks, because here we haven't had a breakout. And if we go back and we look at the exploration and production, we're way above where we were in January. So you can kind of just eyeball them a lot of times and tell which area is leading. And clearly it is the exploration and production group that's leading energy right now. XLI, let's take a look at this group because it has been a laggard for quite some time. We don't see any breakouts here. In fact, it's just been one lower high after another. So I don't know that I would be overly confident in this group until we can clear the 76, 76.5 area. We had some gap resistance there. We have price resistance there. Let's get a breakout there, and then we can start to take a look more in depth at some of the areas. There are some parts of industrials that have been doing very well or are improving. So let me just bring a couple of those up real quick. Truckers, of course, we want to see the transports doing well. And the truckers and especially the railroads tend to give us a real good clue of what's going on in the U.S. economically speaking. And so anytime we get in these nice uptrends, this is good, but we still have some overhead resistance to clear. I like the fact that we had this gap down and a breakdown below prior lows, and then we came right back up. I think that's an exhaustive move in the short term. And so I would not be surprised to see truckers make a run for 860, 870. But the one that's really got my attention is the railroads. This is a key group that I tend to pay a lot of attention to. We've already broken out above those January highs. So while the S&P is lagging, the Dow is lagging, there are key parts, especially the parts that relate to what's going on domestically here in the U.S. When you talk about railroads, you're talking domestic, or at least you're talking North America. Railroads doing very well, breaking out. One day pullback and back off to the races we go, breaking out to new highs again. I find this to be very good. And then, of course, the small caps, they're going to be mostly your U.S.-based companies, and they, too, are making breakouts, as I've mentioned, breaking out to all-time highs now, by the way. We could go back over the last 15 years on a monthly chart, and you can see that this move, isn't it amazing how the noise that we've experienced here in the first 3 months, when you look at a long-term monthly chart, that's all it is really, is just noise. The Russell 2000 continues on this chart to look like nothing's been wrong. We're just continuing to move higher, and now we're breaking out again. So it does bring perspective sometimes when you step back and take, more of a broader view of what's taken place over the last many years. Let's go back into some of the sector information. Let's take a look at the XLV. The XLV, you can see this one has been underperforming as well for a while. I believe, you've got gap resistance and the double top right at around 84. Let's break through. We want to see in a bull market, we want to see wide participation. So we don't have to see leadership from healthcare, but we do want them participating. So I'd like to see a breakout above 84. The fact that the 20-day is beginning to rise, and so far we're holding it, is a good sign. A breakout above 84, though, would confirm it. So that's what we want to keep an eye on. One of the groups, and I've mentioned this one recently, healthcare providers, DJUSHP. I think if we look at this and go back, let's take a look at a 1-year chart. I think it'll show up. This is an inverse head and shoulder pattern, and it's breaking out, threatening to break out today. Beautiful uptrend, left shoulder, neckline, head, neckline, right shoulder, and now we're looking for this breakout. A breakout would measure probably another 160 points to the upside, which would take us to probably to 2000, 2010 level. So healthcare providers, I think, look really strong. Pay attention to UNH, United Healthcare. I think that's one that's been performing pretty well, and it's also one of the best seasonal stocks in the Dow during the month of May. Another stock that looks interesting in this space, I'll go ahead and pull it up, is HCA. It rallied off of this move to the upside. I think you got a nice little cup here forming, maybe a handle back to the 20, but I would expect this pattern to resolve itself ultimately to the upside. Another one, LH, which is LabCorp of America Holdings. Lots of sideways consolidation, maybe a little bit of a left inverse shoulder, a neckline, a head went a little bit lower, comes back up. Maybe this is a right shoulder, maybe one more pullback, but this is another stock I think looks really good in this space. Last sector I want to talk about, XLF, which is the financials. We are seeing some strengthening, and the fact that we've climbed above this recent high, we still got a little gap resistance overhead, but this is a nice flag pattern, straight up, sideways consolidation. We're going to talk about life insurance later in correlation, but this is a group that tends to do pretty well when rates are rising. And as you can see here, it is lagging. Kind of looks a little bit to me like the truckers did, making this breakdown below these lows, and then all of a sudden starting to regain strength. I think this strength continues, and so we'll talk about this a little bit more later in the show. But with that, I'm going to introduce our guest for today, Julius de Kempenaer. He is the author and the expert of the relative rotation graphs, RRG charts. And Julius, Welcome back to the show. Everybody always loves to have you on here to talk about RRG. What do you got for us today?
Yeah, thanks for having me. I want to basically redo a little bit of your last segment. Let me try to share my screen.
Improve upon. Go ahead, improve.
Well, I mean,
another level.
No. It's a different way of looking at things. Let me start with saying that I pretty much have a little bit of a longer term time frame than Tom has. So I always start on a weekly time frame when I look at my RRGs, which is the one that we're showing you right now. This is the RRG of the US sector ETFs, and I have the SPY, the Spider ETF, as the benchmark. And what I see here, there is one sector that is absolutely standing out, even if you have no clue what you're looking at when you look at an RRG. There's one thing that you will see, and there's that big green line moving from the bottom left to the top right with XLE labeled, and that's the energy sector. So without a doubt, that is now the strongest sector in the US. And I will later on dive in a little bit more detail into that sector. If we go over the other sectors, because as you can see, XLE is now the only one inside the leading quadrant, so it's very strong. The other sectors on the right-hand side of the plot are XLK and XLY. They are in the weakening quadrant, but they're still comfortably above the 100 level, which means that they are still in a relative uptrend against SPY, but they're going through a short-term correction. So right now, the leadership in the market, from my point of view, would be energy, technology, and XLY discretionary. Now, the weaker bits and pieces are XLI, XLF, and I noticed that you're calling XLF as a little bit more positive, and I will show you the daily RRG later on where you will exactly see that that's going to happen. So it will align with your daily charts that you just went over. We've got healthcare just about inside improving, but pretty much going nowhere. It's got a very short tail. Maybe you remember that the tails on an RRG will give you an indication about the power behind the move. So very clearly, XLE's got a very powerful move where you will see that XLV, the healthcare sector, very short tail, not doing very much. Materials, not too long of a tail, but it's gaining strongly on the momentum scale. So it's picking up. And the only thing we need now is for this improvement in relative momentum to turn into an improvement of relative strength when it starts to move to the right-hand side of the plot and head towards the leading quadrant. And just like XLE is now the strongest sector in the S&P, the weakest sector is XLP, is the staple sector. So this gives you a rough idea about what's going on a sector level. Now let's quickly move to that daily version and see if we can align that a little bit what you've been talking about the last 5 minutes, Tom. And here you see XLF, and it has been improving. It's been picking up. And XLB is materials, that's picking up. And XLY, the industrials, is picking up. We've got XLK weakening a little bit, and we've got XLE, and that's interesting, having moved through weakening, but as you can see, it's already on its way back up towards the leading quadrant again, and that's one of the stronger signals that you can get from an RRG. If you want to talk in terms of signals, then this type of rotation, as you see in the energy sector, is what's very strong. If we scroll it back, give a little bit more space here. You do that by pressing the minus and dragging it. And then you see XLE here, and we're looking at a date, March 27. And then I can browse through history, and you can see the strong move of XLE, picking up again, moving higher and higher on the ratio axis, and then starting to move down a little bit. And here you see that it starts to very carefully turn back up again. And that's a strong thing. That's a very strong thing, because it means that the sector as such is in a relative uptrend already, but that relative uptrend is not moving into a straight line. It's making higher highs and higher lows, and the rotation that you've just seen here for XLE means that the trend is still up. Anything above 100 is in an uptrend, and you see that the rotation back up means that it's making a new low. So it's a little bit of a corrective move inside that longer term uptrend. So that's the big picture for US sector. Let me put that back to weekly, and you get the big picture. So in very short, XLE very good, staples XLP very bad, technology and I keep forgetting what that is, discretionary, very good, but going through a little bit of a corrective move. Now, one thing that I want to share with you today, and that's a new thing that we've done here at StockCharts. Those of you who have seen me present in Market Watchers Live before may remember that I like to dive into the nitty-gritty of the individual sectors, i.e. the individual stocks. So for today, I had thought to take a look at the members of the XLE sector, the energy sector. Now, you may know that these were not available as ready-made groups. And if you wanted to look at the individual stocks for, in this case, the energy sector, you would need to collect all the ticker symbols, type them in manually in the symbols bar, run the RRG, and then you can, and that's a general thing that you can do with any RRG. You can save it as a permalink. So, you know, a normal sharp chart on StockCharts, you can save the chart in a chart list. Because RRG is different technology, it's kind of different. It's not a regular chart. We cannot, and I have to say yet, because I know that they're working on it, save it as a chart in a chart list. But what you can do is you can save it as a permalink. So for example, the chart that we have right here, if you click on permalink, it'll bring up a box, which is basically a URL. And if you copy that and you save that as a bookmark in your browser, whatever browser you're using, Safari, Chrome, Edge, whatever, they all allow you to save bookmarks. And then you can create, like I done here, a whole set of ready-made RRGs, which are basically just bookmarks that lead to a specific RRG. Now, to make your life a little bit more easy, because all these constituents of these groups, they change from time to time. So I found myself having my permalink set up, found all the members, created the chart, and then, you know, after 1, 2, 3 months, you start to notice that, you know, some stocks are not there anymore, or they have moved, or the index composition has changed, and you have to do all the work again. We have decided to help you and do that work for you, because when you now go to the groups section on RRG, you will find that we have the S&P 500 sector ETFs, which is basically this RRG that you're looking at, which holds the sectors. But underneath that, we have gathered all the symbols for all, in this case, 10 sectors of the S&P 500. So if we want to go to XLE, with just one click, you get all the stocks that make up the energy sector inside the energy sector of the S&P 500. So it's very easy. If you look at the sector ETF chart, you can drill down into the individual members, and you can quickly move, let's say, to technology, and you will have all the technology charts on an RRG, technology stocks on an RRG. When it's a little bit busy, you want to play around with your tail length, shorten it maybe a little bit, but it'll give you the picture. And you also may want to remember the little trick that I always use when browsing through the stocks on an RRG. That's basically sorting on tail. So then we have all quadrants nicely lined up. Select the top one, and then when you press Control and your down arrow, it moves through the next one on the list. So with this, you can very easily browse through all the individual stocks on the RRG, and, you know, basically make up your mind about what you'd like to see and what you'd like to look at in more detail. So this is the little the little new thing that we've done here. Now, as you know, I always tell people to not rely only and solely on an RRG, because an RRG is a starting point for me. It's where you start your analysis. That's where you look at your big picture, and then you pick up the ideas that you get from an RRG and bring them into your own workflow and whatever type of charts that you want to look at. Now, Tom has already looked at the XLE chart, which is what I'll do very, very briefly here with you again, because I'm combining it with my red strength line and the RRG indicators. And the breakout's already been highlighted. This is undoubtedly a very, very strong pattern. We're breaking out to multi-year highs. This 75, 77, 77 and a half area was a very strong resistance area. I believe that alt resistance returns as support. So from a risk reward point of view, this is becoming a very attractive sector because we're breaking out. So your risk, so to say, to the downside is somewhere between 75 and 77 and a half. So worst case, 75. If we drop back below 75, all bets are off. But quite frankly, after such a big base, I don't think that's going to happen, and that XLE as such is going to move higher. And we will see a slightly different, but also a positive pattern in the relative strength line of XLE versus SPY. You see that has been building a base, and for the first time in a long period, like a year and a half, we are moving above a previous high, and we're clearing the horizontal first support level, later resistance level in relative strength. And that move is being picked up by the RRG lines. As a matter of fact, both RS momentum and RS ratio lines had already crossed above 100 a few weeks ago, because this is, again, this is a weekly chart that we're looking at, so it's a little bit longer term picture. So, you know, from a relative point of view, from an RRG point of view, all good for the energy sector. This 80 level looks to be some sort of a resistance, so we might see a little bit of a bounce back, but that could be a good thing because it could offer you potential entry opportunities when we come down a little bit off 80, if indeed that 80 level proves to be a resistance level. Now, on the RRG for the individual stocks, and this is a zoomed in one, because the big one here, this is where you see everything, and preparing for this show, I quickly went over a number of individual stocks, and I brought up, where is it? Here. This is a zoomed in version. So very quickly, the stuff that I like in life insurance is ANDV, HES, MRO, COP. They're all inside leading, making nice moves. Be very careful with SLB, CXO, HP, EQT. And the cool thing is, or the cool thing, maybe it's not so cool, that the two really, really, really big stocks inside the energy sector are Chevron and ExxonMobil, and they are both weak and look to be weakening even further.
Hey, Julius?
Yes?
I was looking at the HP, because I actually, when I've followed you on the RRG, a lot of times my favorite stocks are the ones that are down in that weakening sector, as long as they don't cross that line to the left.
Yes.
And I was just looking at HP, and I don't know if you want to pull up a chart on HP, but it literally is trying to make a breakout today after putting in a cup and a handle back to the 50-day moving average. I mean, this is a stock that I think really looks pretty good on the chart.
That's it.
Yeah.
And what you probably look at, because what we can do here, if we swing this to a weekly or to a daily, let's see where it is, because this is how you drill in. Whereas here's HP, it's just coming out of lagging, starting to turn back up again. So if it continues to, so mental memo, HP on the weekly RRG is in weakening, but far to the right, so still strong. Now, this weakness on the weekly is caused by the daily rotation that we've seen over the past few weeks, where HP moved from leading through weakening into lagging, and now starts to pick up. So with HP inside weakening and momentum improving, and assuming a continuation of the clockwise rotation, moving into improving and moving over there, there's a very good chance that we will see HP on the weekly making a rotation inside weakening, turning back up, and basically following MRO. Because if you bring up the chart of MRO, you will see a very nice pattern. I am with you, Tom. This is a very nice. This is a very nice pattern. If you look,
what this reminds me of, looking at the RRG charts.
Tell me.
And I don't mean this in a disrespectful way at all, but it's kind of like, you don't really know which way it's going to go, but it kind of reminds me, how when you get the hurricanes, I don't know, maybe being in the Netherlands, you don't pay attention to that, but the US, we have all these hurricanes. And they do these patterns where, it could turn back up to the right, or it could go, flatten out for a while. But, they have a tendency to do certain things. And I think with the RRG, a lot of times when you get those stocks that are over on the right-hand side from a long-term perspective, they do have the tendency maybe to weaken during a period of profit taking and then turn back up. That's been my experience of trying to, when I look at stocks on the RRG that I like, it's after they've weakened for a period of time, and maybe on a relative basis they do weaken, but then they start to turn back up. And
that's what we found. I did in my presentation for ChartQuant 2014, and I'll probably do a similar run again later this year. One of the strongest things, for as far as you can do back testing and signal testing on RRGs, because it's kind of difficult because it's so standalone and so different. If you look at a few signals that you can derive from an RRG, definitely a turn back up inside the weakening quadrant, so above 100 on the RS ratio, and then turning up again and picking up relative momentum without crossing over into lagging is one of the strongest signals that you can get.
Mm-hmm.
So how much time do I have left, Tom? Remind me quickly.
Oh, you probably still got another 10, 15 minutes, 10 minutes.
Oh, okay, cool. Okay, cool.
Hey,
Because I want...
before you move on, we had a question, I think, that sort of fits into this discussion.
All right.
They said that, if you have two similar stocks on your RRG with equal entry risks, do you prefer the one that goes from improving into leading, or the one that has been in the lead for a while? Which travel direction do you prefer when you look at two stocks?
Okay, so we've got two stocks with similar patterns, similar entry risk, I think you said.
Yes.
I would pick the one that has on the RRG the most potential left. So if one of the two would be inside leading for a long time already and moving up, in the top right-hand corner with, an increasing risk of rolling over and starting to move down, I'd prefer one that is just about to enter leading or had just entered leading from improving. Or even better, when I see a stock like that HP one that is inside weakening and starts to roll back up, that's even stronger. So if I have a choice, let me make this as clear as possible. My first would be rolling up, curling up again, inside weakening. So inside weakening, curling up and starting to head towards leading again. That's the strongest.
Okay.
Then, if that's not available, then I'd look for stocks that are inside improving, closing in towards leading, but gaining on both axes. So
do you think you could show this on an RRG? I mean, we've got...
Of course.
Yeah, I think it'll be easier for you to explain.
Plenty of RRGs to talk about. Okay, so let's see. So for this, let me give you a good example. So let's isolate MRO, because that was the chart that I had just had on the normal chart. So here you see MRO. So that's probably a chart that you had seen before, because it's very strong and it went... It went through leading and then it moved down, and then like when this happens, especially when this happens, when you move, and that's what we call RRG heading into the if you imagine a compass with 0, 90, 180 to 70 and 360 degrees, when this tail turns into a heading between 0 and 90 degrees. And that only happens when it gains on both axes.
Hey, Julius?
Yes.
The really interesting part here is I was looking at the date, and right there, that's as of May 4th, 2018, where it's turning back up. And if you look at a chart on May the 4th, or roughly about that same time, Marathon Oil was just making a breakout out of a flag, where it had consolidated, which was a very bullish pattern to begin with. So as it was making that breakout, that's when your RRG was turning back up and heading. So I can absolutely see how the correlation here between using an RRG chart and then looking at the price action makes a lot of sense.
Yeah, so that's probably here. This is April.
Well, and you're looking at the weekly chart. Pull up the
daily. So you're probably looking at the daily indeed. So that's probably that little thing here is probably what you see as a flag on the daily.
Yep.
Just below that resistance level.
Right in there. Yep.
Right. This one here. This little consolidation, this little flag here.
Yep. So that breakout of that pattern was coinciding with what you were showing visually on the RRG chart.
And you see that on the daily RRG, because this is where MRO went into the leading quadrant, and this is where it turned and dropped into weakening, and here is where it turned back up. So it's the RS ratio is above 100. RS momentum, the green line, is below 100. So we're inside weakening now, but we turn up. And just after this is where you get the strongest signals. And that's when you have the break here. And this is the weekly breakout level. This is your daily breakout level. This is your weekly breakout level. So yeah, no doubt about it that this is a very strong stock. And it has probably still plenty of potential left. Look at this, you probably run into some problems here around 23, maybe 24, but if we can clear that, you're all the way up to 30 without a problem. And if we measure from this pattern here, if I would tell you a story that this is an ascending triangle, you probably believe me. So we'll have like 6 to 19, so a minimum of $10 to $12 of potential. So 30 should be definitely available for MRO, and from a relative point of view, there is all the potential in the world. Awesome. MRO. So what else do we have here? I need to bring it to the end because otherwise I'll be fooling myself. Yeah. Chevron and ExxonMobil. I'm actually working on a blog, and the title of the blog will be that you can actually beat the energy sector by avoiding ExxonMobil and Chevron. So basically, you can buy all the stocks in the sector. If you just don't buy Chevron and ExxonMobil, you'll be doing fine. And that's about 30% of the sector. So you got to buy the other 70%, and you'll probably very easily be outperforming the sector as such. Let me quickly show you the charts, because there's one more thing that I want to show you on a sector level, which I think is very interesting. Chevron. Chevron, we don't like. Why not? Because from a relative point of view, this is weak. There is nothing going on from a relative point of view. We've rolled over into lagging, and you see that the green line is just above 100, which puts it in the improving quadrant on the weekly chart, but it already started to roll over. And this is weak. So this is the opposite of what we saw curling up inside weakening. This is rolling over inside improving, which is something that I'm very careful with. And especially when I see a very long-term topping pattern like this on the relative strength chart itself, and I see a price chart which is running into resistance. This is a serious resistance level. And I see that a low has been formed, which was lower than the previous low. I'm not very comfortable with Chevron at the time. And a similar thing happens with ExxonMobil, which shows a series of lower highs, major lower highs for about 2 years already. And if we look at the relative chart of ExxonMobil, we see that it has just broken below a major support level on the relative line. It's just confirming its downtrend. And on the RRG, it rotated into the lagging quadrant already in October last year. And even the RS momentum line has not been able to comfortably go back above 100. So it's way inside the lagging quadrant and pushing further down. And if you look at this relative strength line, that's not difficult to understand. And from a upside potential, this is very, very limited. So even if ExxonMobil starts to bounce, it'll be very, very limited for two reasons: because relative strength is running into resistance very soon, and price is running into I call this a very heavy resistance level. So yes, XLE, energy sector, outperforming the S&P, leading sector at the moment. Just avoid the two big stocks in there, and you'll be super fine holding some energy stocks. Now, to wrap up this segment, I want to do an exercise with you that I do from time to time when I look at my long-term sector rotation. And what I do is I try to match what I see in sector rotations on the RRG with, and this is probably something, wrong one, this one here, you may be aware of. This is the sector rotation model that is presented under the perf charts on StockCharts.com. So if you go to the perf charts and you scroll down, you will find this. It's probably a hidden gem. I'm not sure if everybody knows this exists, but this is done by Sam Stovall, a very respectable analyst in the US, been working for S&P for ages. He moved on to another company. I don't know what the name is, but he's very good on sector rotation work. And he came up with this sector rotation model. And it's the reason why we did the poll to ask you guys, where do you think we are in the economic cycle? Because this is the model that basically says the stock market is leading the economic cycle by a number of months. I think it's like 9 to 12 months or something like that. I'm not sure. So what I try to do every now and then is look at the RRG and then put a call or a qualification on each individual sector, whether they're good or bad. Sometimes it's not always easy to do. Sometimes it's not very clear. But what caught my eye today was that energy apparently is the strongest sector. So that's very cool. And materials is improving. So these are right in the middle. Technology is not so strong. Cyclicals is not very strong. Staples is the weakest. Healthcare is Financials long term not that strong. Utilities inside improving but rolling over. Whether that's a minus or a neutral doesn't really matter, because it looks at sectors that are doing well during certain economic periods. And if I look at the poll, most people think that we are in full recovery on the economic sector. So that is here. And that's interesting, because it would mean that we are past the market top or very close to it. Early recession is the second one, which means that we're already in a bear market or getting out of it. That'll be very interesting. But the full recovery I can live with. Now, the other thing that I've tried to do, because sometimes the sectors are difficult to read or they're not conclusive, and there are a few other factors that you can look at. And one of the other interesting things that caught my eye is the yield curve. Because what's happening in interest rates and yield curves, and you heard Tom talking about interest rates, and I don't listen to the show every day, but I tune in 2 to 3 times a week, and I hear him talk about interest rates all the time, and he's basically talking them up all the time. So this is bottoming out. They're not rising rapidly, but they're bottoming out for sure. They've been going up. And the yield curve at the time is normal, and in full recovery, it's flattening out. Now, the second thing that I'm not sure if everybody is aware that we have on StockCharts.com is the dynamic yield curve chart. It's when you go to the free tools, it's hidden all the way down. Maybe not everybody scrolls like there. It's a dynamic yield curve, but it's very cool. I am going to assume that you all know what a yield curve is. Where's my yield curve? Where did it go? Come on. It's basically showing you the yields for all the various points on the curve. And this is the curve as it is right now. And these are the ones in there, from short-term, 2-year, all the way up to 30-year yields. So this is how it looks right now. Now, the cool thing is, what you can do is you can scroll this back in time. It's a little bit like the RRG technology that they built. If we put it here, and this is late 16, early 17, you see that the curve, yields were much lower, and the curve was much steeper. And we can actually put a trail on it, just like we can with an RRG. So the dark is where it came from. Now watch this. We're going to animate this. And you'll see what happens since, and this is 11 October 2016. You see that yields are, the red one is the actual one. It's moving up. In general, it's moving up. It still has a normal shape. The low end is cheaper than the high end, so you gotta pay more if you want to lend money for longer. You're gonna pay more than when you have shorter duration. You have to pay less, and you will see that it changes. And now I'm gonna manually do it because we're now at December 2017, and you've seen that we started about here, and we're already all the way up there. And now look what happens very recently. That long end is coming down, the short and the middle is going up, and we're actually going into a very flat yield curve while interest rates are rising. There you go. March, April, getting even flatter. Second half is getting flatter. May, we're now in May 15, 16, and here we are today. Look how flat this is compared to what we had in the beginning. So that puts me in bottoming out. Well, maybe we should put rising here between this. Yield curve is definitely going from normal to flattening out, which is early recovery to full recovery. So it lines up with the two sectors that are doing well, energy and materials, and a period between early and full recovery. You could call this is a market top. Now, the problem is that this is a very long-term rotation model. So this move, this could be months. This could be months away. So we could have a situation where energy and materials are leading the market for weeks, maybe months to come. But you got to be aware of the fact that we are definitely not any longer in the early recovery phase, which is the strongest piece of the market. If I look at certain relationships on an RRG and in sector rotation in general, and there are two that I keep an eye on, and that's the relationship between XLP and XLY, consumer discretionary and consumer staples. Consumer staples is here, consumer discretionary is there. Consumer staples is the worst sector at the moment. Discretionary is, in terms of RS ratio, the strongest. I prefer energy at the moment because of the momentum play, but it is stronger, and it's much, much stronger than staples. So this spread, discretionary over staples, is basically calling still for a bullish market. And another one that I look at is XLF versus XLP, financials against staples. And that's financials here and staples there is still in favor of financials, despite the weakness that we've seen very recently. I think that the spread between financials and staples is also still in favor of a continuing up move. And if you look at the S&P chart itself, I think that we all agree that we've just broken out of that big triangle pattern, and we've seen enough evidence that there is the the path of least resistance is to the upside for the general market. So I'd like to leave it at this for the time being. I'm going to scroll through the chat section to see if there are any questions that I can address later on, and I'll be back with the correlation bit later on. So Tom, it's all yours.
Yeah, that was a great presentation, Julius. And for those who are really interested in the RRGs, stick around because we're not done with them. We are going to have a correlation segment coming up in about 20 minutes. And I think it's going to be absolutely fascinating. I think what you can do here with the tools at StockCharts, using some of the things that we talk about on the show all the time, and then marrying it to what Julius has talked about in terms of the RRG, I think we got a really interesting segment coming up. So definitely Julius has agreed to stick around, which is awesome. And we're going to give you the three-headed approach here in about 20 minutes to finding potentially some great candidates, trading candidates. So we'll get into that in a minute. But for now, let's go ahead and switch over to the 10 in 10. And Erin, do you have some stocks there? I know MVIS was the first.
Yes, it was. And right now, let's see what's leading for the most popular is so far Square is the leader of requests. So we'll see if that'll hold up after your first stock symbol.
All right, let's go ahead and jump in then. First one I'm going to do, I haven't done it yet. I was actually following along very closely with what Julius was going over because I do find it fascinating. I think that the RRG charts do provide a visual, that you can really follow exactly what's going on in terms of not just what a stock is doing, but what a stock is doing relative to a benchmark. And I think that's really important because when you see these stocks weaken sometimes on the right-hand side of the chart, that's a lot of times when you're seeing an ascending triangle forming or maybe a handle after a cup. That type of weakness may show up on an RRG as though that stock is weakening when really it's just getting ready to turn back up. So very fascinating stuff. But let me go ahead and take a look at MVIS, get through the 10 in 10, and we'll get into that correlation segment in just a little while. First, MVIS, I love the gap up, very heavy volume. A couple of things stick out to me as soon as I look at this chart. Number one, I don't like to chase these stocks when they do gap up. I would much rather see how they trade after that gap up and then kind of figure out, do I want to wait until it pulls back? Do I think it's going to continue to rise? In this case, we were moving up on MVIS. Look at that black candle. A black candle is the same as a red candle. They're both filled candles, meaning that they close below the open. That's how you get a filled candle. The difference between the black and the red is that the black candle still closes above the prior day's close. So it's below the open, it gaps up, comes back down, but it's still up for the day. That's the black. The red candle is not only is it closed below the open, which makes it filled, but it's also a down day from the prior day's close. So just want to point that out for those of you maybe who don't follow candlesticks. But when I see a black candle, I'm normally looking for a pullback, especially after a gap up with very heavy volume. And look at what we did here. We came back down and literally filled this gap all the way back to $1.35. So we opened up at $1.60, got as high as $1.65. Anybody buying and chasing on that early strength is literally not feeling very good the next day when you're down 30, 25, 30 cents. But all it did is it went to a gap fill, and then look what happens. 5 days later, it's right back to that 160 level. So if you are of the mindset to see these gap ups, learn these gaps in the candles and how they normally trade. I'm not saying every time you see this, you're going to get a beautiful pullback to gap support and turn back up. But if you're trying to manage your risk, do you want to buy at 160 or do you want to buy at 135? Hopefully you've picked the latter. Here with MVIS, comes back, fills the gap, moves higher. Now what I see is it challenging price resistance. So I think it's in the middle still of a range. I'm not a big fan of buying it at 160 until it shows me it can break out. But a close above 160 with increasing volume would likely take us up to about that 180 area to challenge the early January high.
All righty. Excellent. So our most popular that did win is Square. So SQ is your second symbol.
Yeah, Square did recently report some decent results. I think they beat on top and bottom line. And for now, I think it's trading within a range, which I find actually to be pretty bullish. It's in a wide range. This is not, your typical, move up a couple bucks, move up or move down a couple bucks kind of a stock. This is one that tends to actually be a little bit more volatile. So I'm going to say from about 45 up to 58 is a trading range. And we're getting really close to the resistance. I don't like to buy at resistance, even if I like the stock. I just don't, off of an uptrend. You can see the RSI got overbought. We haven't made a breakout yet. This is not the entry time for me. Now, if you think this is the nice uptrend, then wait. If you get a pullback at the 20-day, maybe you put in a little price support level in here around 52. You test 52 and change, hit that 20-day, and then maybe you can trade it based on 52 being a closing stop, 58 being a target. But I wouldn't buy it at 52 using 58 as the target and 45 as my support, because obviously your reward to risk is really skewed. But for me, I still like the stock. I definitely would be watching that rising 20-day moving average right here as support. But I think eventually we're going to get a breakout here on Square.
All right. Number 3, and I did look at the RRG, and taking some of Julius's advice from earlier, I am going to pick RIG in the energy space, Transocean.
Yep, my guess is that this move right here was probably moving from the strongest quadrant into that weakening quadrant on the right-hand side. If you can kind of picture it in your mind, like Julius was showing, that's what I'm guessing this little pullback did. And now it's probably moving, turning right back up toward that that strongest quadrant, if not already in it. But let's pull up the annotation here quickly. And the high right there, you can see we got up almost to 12.5 back in January. Pulled all the way back, hesitated there, pulled back, hit that 20-day. Look at that nice bullish piercing, or actually not piercing, that's an engulfing candle right off the 20-day moving average. That's pretty good bullish sign, and we did follow through with some more strength. I think volume trends are good. I like RIG. I think it goes higher. It is overbought in the near term, so I'd follow that 20-day moving average. And when you get those pullbacks and you get close to the 20-day moving average, I think that's when it's time to pull the trigger.
All right. The next one I have is in a similar formation. So they are in the weakening, but they have just started to make their way, make that turn back up. And IPI is now moving northeast. So IPI, Intrepid Potash Materials.
Yep. Big breakout on very nice volume. I get those price breakouts and I get volume. To me, that's #1 signal in the market. Here you can see clearly, first of all, shooting star candle off of an uptrend. That's usually a kiss of death, and it was in this case. I mean, you don't know it's going all the way back down here, but I would look for a pullback. Here we got a bearish engulfing candle right at price resistance. But look what happened here. We actually made the breakout. So I think that's very bullish. It is only a $5 stock. So, it's probably best for those who are willing to take on some additional risk. Great volume, though, on this breakout. I would expect one of two things. If it fails to hold this price support level on the way back down, I really like it on the rising 20-day, and that 20-day should come up rapidly. So I like the stock. This is one that is going to be somewhat volatile. So, prepare yourself, maybe put on a crash helmet.
There you go. This is a popular one we haven't looked at in a while. Walmart, WMT.
Yeah, Walmart just reported earnings. They came in, I think, $1.14 versus $1.12, gapped up, and like so many stocks during earnings season, just didn't hold, moving back down. Walmart's just not been a great performer. I think I've pulled this one up on a weekly chart before, and I think $80 is an interesting area. I think we could go back down and retest this recent low around 82. I think as you get down the lower 80s, Walmart, maybe not so much from a technical perspective, but probably more from a fundamental perspective, value perspective. I think it does look better. And again, on the long-term weekly chart, I think $80 presents some nice opportunity. So if I was annotating again, for me, it's really just about drawing in that support line. We gapped down on very heavy volume, and we have not yet closed below 82. And as I said, 80 on a weekly chart, I think from what I remember, looks pretty good. So I think 80 to 82 is probably an area where you might consider Walmart. But in the meantime, a breakout would probably be more up around 89. If you get it through 89, then I think Walmart could be starting a run.
Okay, let's see. From our technology software, Splunk. I know you love the name of that, SPLK.
Yeah, I mean, it's, next best thing maybe would be Splat.
Right. Somebody mentioned a flag.
Yeah, a little bit of a flag, and also a breakout and coming back down, testing price support. I mean, I love this. Volume could have been a little bit heavier. It definitely picked up on the breakout, which I like. Came back down, and notice that it's low. was it had tested price support and it was getting really close to that rising 20-day moving average. That in a rising market is nirvana for me as a trader. I like these stocks that look good, break out, pull back, and hit a rising 20-day moving average. And when it happens to coincide with price support, even better. I think now 117 is your target short term, and 110 is your key support level.
All right, let's see. The next one I have for you is our only utility that was requested, AT&T. Of course, symbol is T.
Yeah, the whole group not doing well. I don't really see a lot of, I'm looking for momentum. I'm a momentum trader. I believe we're going higher. I'm looking for stocks that are in an uptrend. They're pulling back. This is the exact opposite. This is in a downtrend, and it's actually been bouncing. So I am not a fan. I would say that to the upside, before I would even think about AT&T, you've got probably 33.40 to negotiate. You could even draw a line in here at the top of gap resistance. This is going to be an area at some point we'll probably go up and challenge. Who knows when? We may go back a lot lower beforehand. But look on the selling here. Look at the volume on the selling. And now this little bounce. May has been a good month for the stock market. We've been seeing almost daily rises. And look at what AT&T is doing. You've got a relative underperformer. Looks horrible on the chart. 20-day test is probably going to be a failure, at least initially. So I'm not a fan. I would avoid AT&T.
All right. Let's see. Let's go with LPX, Louisiana Pacific Building Materials is the industry.
LPX, is that what you said?
Yep.
Okay. Another one that's been downtrending for the last several months. I'm going to go out a little bit further just to see maybe if it's got a longer term uptrend. We go back to last year. The stock's trading below where it was back in September. Most stocks are quite a bit higher than we were back in September. So relative basis not performing well. And you see how when we get these downtrends, volumes picking up, look at the failure. Failure comes right at that 20-day moving average. So for me, I wouldn't even consider the stock until one of two things happens. Either we break through this 20-day moving average, or on a recent low, I'm going to show you what I think to be a very, very significant price support level down around 25.5. Big breakout here on heavy volume in September. Multiple tests holding at 25.5. If we were to go back down and have lower prices, have a higher PPO, have a positive divergence, when we hit price support at 25.5, I'd be interested. Until then, right now, I would avoid a stock like this.
Okay, let's see. What did I have next for you? How about NEWM, New Media Investment? It's in the publishing category.
All right, NEWM, I think it's kind of consolidating in somewhat bullish fashion. We did get a big gap down. We're trying to get back through this gap resistance area, which also kind of coincides with the high. No doubt, I'd like to see some volume come in on a breakout above this high. So let's call it 17.25 or so. We can get a breakout above that level and get some volume picking up. I think that would be a good sign. Another thing you could watch is a trend, the trend line. If you connect the recent lows, I could go all the way back to a prior low and draw it, but I'm just going to start from here and maybe just look at something like this and major price support being down where we gap down to. So I'm going to say key support resides between about 15.75 and 16.25. And what you're looking for is a breakout above 17.25.
All right. Let's see. Specialty REITs, Weyerhaeuser, WY.
Yeah, I think this is paper company.
Possibly. It says it's financial.
Okay.
Specialty REITs.
WY. Yeah. WY, trending higher, which is good. Still got some overhead resistance. Doing better than the overall market, though. It's not far from breaking out. Certainly better than the S&P 500. A couple areas maybe to keep an eye on. I'm going to say that 36 support level. Let me annotate this. And this might have been the last one. I don't know. You can double check, Erin. I was thinking.
It is.
I think you're in a range right here, short term. The recent high at 37.50 in January marks some pretty important resistance. And then as we tried to break out here, you can see the PPO kind of moved back down. So we had a negative divergence, and then we had a dark cloud cover reversing candle right on the top. And that essentially brought us right back down to that 50-day. That's what I look for when I get a negative divergence, I look for that 50-day test and a MACD center line, or excuse me, PPO center line test right here. And we've already gotten the 50-day test, and we're heading for that center line test. So I might use the 50-day as my closing stop. As long as I hold above that, I'm okay. Looking for another trip back to 37.5. Breakout above 37.5 with increasing volume is what you want to see.
All right. And that is 10 in, well, almost 10. Not bad, not bad.
12, 13.
Yep. So here are the symbols that we did today. I will have these up in the Market Watchers Live chart list with those annotations. You can find it if you go to the blogs tab, find the Market Watchers Live blog, and the link is right there at the top. And I believe I have it in every single Market Watchers Live recap entry as well. With that, let's go ahead and I'll take the screen. We could talk very briefly about ChartCon is coming up in August. It is an online conference. We recommend you register as soon as you can. At this point, we have a huge amount of speakers, unbelievable speakers. If you want to check out the agenda, it is there as well. The main thing I want to let you know is that it is online, so you do not have to fly to Seattle to participate. You can participate from the comfort of wherever you'd like to be. And not only will you get to watch the conference live if you're available to watch it live, but you will have the opportunity to watch it in the future. You'll get all of these presentations that you can review at your leisure whenever you want. So highly recommend you check it out. And next up, let's do the market update. All right, I'm going to refresh this just to make sure we're seeing what we need to see. Well, we can see the indexes, although, oops, sorry about that. We can see that the indexes, although starting off fairly strong in the morning after a dip, they're now falling back below yesterday's closes. So we're seeing some negative activity right now from the Dow. S&P is barely positive right now. NASDAQ is now negative. Again, the small caps really seem to be outperforming. We're seeing a flag really formation here. So Russell 2000 is higher, but it's consolidating right now. TSX, you can see we have this big rounded top here, likely participating in the pressure of the US markets right now, turning down, but still in the positive territory. Treasury yields are up again today. We're now reading at 3.106. UUP is mostly unchanged, up only 1 cent at 24.57. Commodities had a nice run earlier in the day, but are now pulling back. And similar, obviously, to USO. But now we're seeing USO in negative territory, down only 1 cent right now at 14.45. Gold is up slightly, and we can see that the VIX is really, we had it trail quite low earlier today, probably while the market was running higher, but now we're starting to see a little bit of concern. The VIX getting just a bit higher than we've seen yesterday, but we're still under a reading of 14, so I'm not too concerned about that. And TLT, you can see all day, all negative. Tried to make a run at lunchtime at the beginning of our show, and it looks like it's going to pull back again toward those intraday lows. And with that, I'm going to conclude the market update and pass it to you, Tom, to open up our correlation. And before you get too much started, I have to say, and I didn't pick them, but a lot of people must have read your article this morning because there were at least 4 or 5 life insurance companies that were requested for the 10 and 10.
Yeah, and I tell you, this is going to be a great segment. And I think this is going to show you the power of being able to analyze the market. And by no means does this mean that the things that we talk about are going to turn out to be great investments. I mean, you still always have to have your stops in play. I've had some, what I thought were great themes looking at the market. The trades didn't work out because things just changed in the market. So always keep that in mind. Make sure if you get into anything that you do have your stops in play in case something changes. And the market doesn't always do what you think it's going to do. But I think this segment's going to be really eye-opening from a standpoint of being able to use the tools that you have at StockCharts to really zero in on some high confidence trades, not again, not guarantees, but high confidence trades. So let me show you first off a chart that you've seen before many times. And, you might be saying, oh, no, not again. But I think it's really important because it does show you the importance of being able to establish key relationships. And this is one that shows the U.S. Treasury yield versus German Treasury yield and the huge move up that we've seen since 2009. But it doesn't always result in a rising dollar. Normally, if Treasury yields in the U.S. are rising faster than other parts of the country, the dollar should rise. And I do have a correlation indicator down here that shows you that the difference between the U.S. Treasury yield and the German 10-year Treasury yield, that correlation of that difference versus the dollar is very strong. It remains mostly in positive territory and many times at 0.75 to 1, and 1 is the highest reading you can get. If you just have something that stays at 1 all the way across here, it's essentially going up hand in hand. Those two assets are traveling together. -1 would be traveling opposed. But I bring this up because this is kind of going to be a lead into what I want to talk about with the life insurance group. We've talked about many times over the past few months how for the third time in 10 years, we saw a negative or an inverse correlation between what the U.S. rates were doing versus Germany and what was happening with the dollar. Each of the past 2 times, interest rates were going up and the dollar was going down. You can see that in these red shaded areas, which was very unusual. And that's what created these negative or inverse correlations. But coming out of it, what you expect is that we're going to go back up into this positive area because these two tend to be very positively correlated, and it makes common sense to me. They should be. If rates go up higher or faster in the U.S., that should strengthen the dollar. So here you've got the dollar coming out of this inverse correlation, flying to play catch up to the 10-year Treasury yield, the difference of U.S. rates versus Germany. Same thing in 2014. After this inverse correlation, we go flying back into positive territory in terms of correlation, and the dollar explodes. Kept talking about how, and Erin, you've been very bullish on the dollar. I've been bullish on the dollar, and I don't think it's anywhere near being done because we are breaking out to new highs on this ratio between the 10-year Treasury yield here in the U.S. versus Germany. The dollar has been going down for a while. I think it's going to play a lot of catch up. And as it moves higher, you can see that we're moving back into positive correlation territory. And that, in my opinion, is why the Russell 2000 is completely obliterating the S&P 500 right now. I think it continues because I think the dollar continues to rise. I think all the indices move higher in 2018, but I think your real winner is going to be these small caps as we move forward. Now, with that, let's move on to what we wanted to talk about in terms of the correlation and this particular segment. 10-year Treasury yield. Here is just this decade going back to 2010. But here you can see huge move to the upside in 10-year Treasury, breaking out to 7-year highs. Well, there's a correlation between the 10-year Treasury yield and the performance of life insurance companies relative to the S&P 500. Look at this positive correlation. When the yield is rising, insurance companies, life insurance companies, tend to outperform the S&P 500. It's just the way it works. Look at where we are right now. Look at this inverse correlation. So essentially what we have had are rates rocketing to the upside and life insurance companies, for whatever reason, underperforming the S&P 500. This is highly unusual. Maybe someone out there is aware of something that's happened where this positive correlation suddenly is not going to prove correct anymore. I don't believe that's the case. I think life insurance companies are getting ready to make a big move to the upside. So with that as kind of our background for this subject, I thought, Julius, maybe you could bring up the RRG charts and look at some of these life insurance companies and maybe point us into some of them that are outperforming their peers so that we can kind of be ready if life insurance does, in fact, begin to make a big move to the upside.
Yeah. Okay, let me grab the screen back.
Not to put you on the spot or anything, but we want some winners here.
Yeah, no. I got it. I know why you invite me. Okay, what I've done first is, from a high-level perspective, I put the life insurance index against the S&P on an RRG, just the life insurance index and against the S&P as a benchmark. And it's a weekly RRG, and it's got the maximum trail. It's got 30 weeks of tail. And you see that the week period all the way through lagging, it has reached some seriously low levels. But since 4, 5, maybe 6 weeks, it has started to pick up some relative momentum and started to slowly move higher on the RS ratio axis. So the heading, so to say, for this segment, for this industry group, is definitely positive. It moved into improving. It's still gaining on the momentum side, so that's all good. Now, if we switch to a daily chart, similar setup, you will see something similar. It's inside lagging, but it's starting to pull up. So we are in the early stages of a move, which is good news, because you want to be in a move as early as possible. So it's starting to move up here. There is still some risk around it, but given the longer term picture, that the long term is already there, maybe we need a little rotation on the weekly extra through lagging and moving before moving back up. But it's definitely a sector with potential. Now, what I did is because there are roughly around 40 ticker symbols I found on the database of StockCharts in this industry group, and I've divided them into large, mid, and small cap stocks. So I created 3 RRGs, and I'll try to work you through what I see here. So this is these are the large cap life insurance companies against the Dow Jones US Life Insurance Index. This one you want to avoid, UNM. Don't know what it is, but looks really, really bad. And here, this ING, you also really don't want to have it. Of course, that's a Dutch company. So very clearly, you don't want to do that. What I like is there are a number of large caps, this group here, which has probably caused that momentum up move that we've seen for the index, but they're now rolling over. Doesn't mean they're bad, but they're rolling over to some extent. I like MET and MFC. MFC, not so much. MET, definitely. We'll look at the chart. And PFG seems to be a promising chart right now. So if we look at the mid cap, so this is the mid cap section against, again, the life insurance index. You don't want to have AIG, and these have all been leading, and they're rolling over, but they're all still good. I've no particular preference here. They're pretty nice. That Voya and SLF came up in a different section. I'll show you in a minute. And these are the small caps. They're pretty much all over the place. G&W, EHTH, very good, very strong. Very good chance that they'll curl back up, and G&W is the leader in this small cap section. Now, notice that I've put all these groups against the life insurance index. What we can also do is put them against SPX, and then we can see the groups against the bigger market, and you see that large caps are turning back up again. Also note that I've switched to daily charts to be more in line with you, Tom, and Erin on your time frame. So hopefully we'll have a little bit more of a match here. And MFC.
Keep in mind too, Joyce, here, just to let everybody know, I mean, you already showed that the DJUSIL was very weak relative to the S&P. So as you start plotting individual companies against the S&P, you're going to probably expect most of them to be left side of that vertical line at 100. Is that correct?
That's absolutely right. And then the nice ones, they start to stand out. And here's where MFC comes out. And the other one is MET. So MFC and MET. PFG is still here like okay-ish, but not that good. MET and MFC are the ones I think we should focus on. And then we can do the same for the mid-cap section. We've got a different picture here. And here, SLF comes out. And remember what we just discussed about curling up while inside weakening? There you go. Here is Voya.
Yeah, we're
turning right back up.
We're going to talk about Voya in a little bit.
That's a good one.
I'm going to let you go through the small caps. Pick one or two, and then I want Erin to bring these charts up, maybe, and look at the P&L. And let's take a look at some of these and see what they look like.
In the small cap section, I'd go for G&W, because that's the one that's really still upside in leading, and I think could provide potential. We don't have time to do it, but the other thing that you could do is take the large cap group and put it against large cap, put the mid cap and put it against the S&P mid cap as a benchmark. Again, gives you a little bit. Here you see that SLF pops up and GIY pops up. And if we do that for SML, you will see that G&W remains the strongest one. And finally, you could also use $1, but we don't have time for that. I'll do that in another section. Play around the.
All right, my turn. Let me get a few in here before we got to go.
Of course. Yes.
Got a handful there to take a look at, Erin.
Okay, so just real quick, if you wanted to scan on your own, you can scan by industry group, and then I added volume. But I'm going to go over just those particular ones that Julius mentioned. And I'm actually going to start with Voya because I guess, should we be open about it? I think both Tom and I picked this one up this morning. So
we were actually talking about this before the show started, and we were getting into this. This is a way we can kind of look for life insurance companies and so forth. And I look at Voya chart and I bought it. I saw the increasing volume and this breakout of an ascending triangle. And I loved life insurance to begin with because I do think that we're going to get that correlation kicking in. And I think, Erin, you said you went with it as well.
I did. So I'm
I didn't.
Yeah, you didn't. Okay. So look at this, and this is the reason I did, because Tom mentioned it, and we always do that. Hey, have you looked at this chart? Have you looked at that chart? And this was one that he asked me to look at, and it was pretty clear to me it was doing all the right things that I wanted to see. I followed chart patterns, of course. PMO is important. We've gotten that sort of fake out sell signal. Now we've got the buy, and look at the momentum on this, obviously heading higher. Already had the really great configuration of the EMAs, strong scooter. And look here at the OBV, all these rising bottoms, right in line with the rising bottoms on the price trend. So really today we had the big breakout. In fact, I'll just see, I think I can get that in here. We broke out from this short-term overhead resistance as well. So I think this one looked especially good. Let's go ahead and look at, I think you mentioned G&W was one you really liked. And yeah, quite the breakout. This one's got a little more momentum already on it. For my taste, it looks like it's done a lot of the running. The 50's below the 200, so that always kind of concerns me. So while it has a strong upside momentum, and I do have an intermediate term trend model buy signal with the 2050, improving scooter, but to me, I might wait it out because that PMO is awfully overbought right now. And let's see, Met was one. I wrote down about 6. This one looks fabulous, and I will annotate it and show you why I think so. There's a couple of good things going on here. Right now, we're sitting at that overhead resistance. We're trying to break out above it. And look at, we've got a PMO buy signal right now. I'll just get some little arrows out. So we got the PMO buy signal. You've got the rising OBV, which is really nice. And even the scooter is starting to trend up a bit too. So I think this one looks good. And then when you look at the areas of overhead resistance, I think there's still some work to do here, but that's not a bad thing. It gives you a sense of where we're actually going here. So this lines up with that bottom we saw at the end of December of 2017, and it also lines up with the top we saw back in July. So I think that'll be your next level to kind of pay attention to. And then we've got gap resistance right here. So there's a lot of levels of resistance here. The 50's below that 200. So I would be watching very carefully as we move up through those resistance areas. Let's see, MFC was another one.
Yeah, do you have any comments, Julius, on any of these charts as you look at some of these patterns?
No, I think we're doing good. We can this is a great way of showing how you combine Erin's approach, your approach, and the RRG approach, to pick the best of the best, basically.
Yes.
So this math thing came out, I think, for all of us as good.
Yeah, this actually, I think this looks pretty good as well.
So which one was the one that you thought had gone too far? That was the first one that you picked.
Oh, goodness. I think
PNW was one that
PNW.
Looked like it was probably needs a pullback. But honestly, I think if you got a pullback on the stock, what you would see on the RRG chart is it simply moving into that weakening temporarily. And then as it starts back up again, I would expect it to move right back up again, the way you showed.
Yeah, that GNW is way up to the right on the RRG. So, that's logical that it's overstretched.
Exactly. I would just, I think a pullback on that. I like this Manulife Financial. We got that intermediate term trend model buy. We have a PMO just getting into positive territory. So this one I think has more room to run because you can see that the PMO can get all the way up to 3 as far as it's concerned. You've got the rounded bottom going on here. We didn't get the pullback as much as I would say for like a handle on this, but I like that breakout. There's still a lot of upside potential before you get to these areas of overhead resistance. And again, great OBV, scooter improving. So a lot of good stuff there. And then I think PFG, right? That was one you had mentioned. And then we'll close it up.
Yeah, this will be a last one so we can wrap up.
Got the short-term trend model buy, got the PMO buy. Look at that OBV. Talk about some accumulation going on here. Scooter's starting to improve. So I think this one has, you could make a case for a little bit of a flag here, and that's a breakout from that very short-term flag. So I think this one looks pretty good as well, Principal Financial. So there you go, putting it all together.
Excellent. Well, we're going to do a quick summary slide, but I hope everybody enjoyed that because it's a way to start with a theme and then use some of the indicators at some of the tools here at StockCharts to really come up with a pretty darn good plan to come up with a stock within a group. Now, of course, we're expecting that the life insurance is going to start to make a move. And if it does, we looked at some of these that are outperforming on a relative basis. I think here on the slide, you'll be able to see some of these stocks I think performed very, very well.
There you go. And this again will be up in the Market Watchers Live recap. I don't think we'll have these charts available, but I will have some screenshots and such for you there.
Hey, Julius, thanks again for coming on. I look forward to you being with me next Monday and Tuesday as Erin gets a couple of well-deserved days off. And, we'll talk a lot more about these RRGs next week. Thanks again. Absolutely,
no problem. Thanks for having me. See you next week.
Yep. And it's still going to be a full week. We've got everything stock charts coming up tomorrow. Julius, as you said, will be here to co-host for me, and David Keller will be in on Wednesday of next week.
Awesome. I want to thank everybody for stopping by. It was a great show today. Please remember to complete the survey as you exit. I'd really like to hear what you thought of the correlation segment in particular today. And of course, love to hear what you thought of Julius's presentation, which was awesome. As a quick reminder, Market Watchers Live airs 5 days a week, Mondays through Fridays from noon to 1:30 p.m. Eastern Standard Time. Have a great Thursday afternoon, everyone, and hopefully we'll see you back here tomorrow at Friday. Happy trading.
This video will show you how to add a date line to your charts. So if you have a whole bunch of stuff piled up here and you want a date line farther down, there is a way to put it on there and how to move it. So down here under indicators, it's one of the options, date time axis, and by just moving it up and down with these triangle arrows, and notice this little blue arrow that moves with it, it'll help you position it exactly where you want it.